The possible unraveling in the perception of wealth is far higher now than it has ever been if and when we enter a period of pessimism. Since I claim that we could defeat the competing 1929 and 2000, I believe we have advanced well beyond that. There are instances of widespread insanity, meme investment, etc., for which neither 1929 nor 2000 can be used as comparisons. There was Pet.com in 2000, and while they were quite magnificent, they cost hundreds of millions or millions of dollars. We have ludicrous things today that are worth billions, and in some cases, tens of billions of dollars, and were the most remarkable speculation in 1929, and while our fall of 80% is alarming, the next tier of risky stocks also saw a decline along with us. The market has a built-in self-correction mechanism, but its timing is a touch off. The SPAC index is down more than 20%. The issue is that sometimes it corrects rather quickly, and other times it corrects incredibly slowly. However, if you look back to 2000, let's say the previous leader in speculation, things look much better. The market reached its peak in March 2000, and between March and September, the Pet.com essentially went out of business. The internet stocks essentially fell by 80%, but the whole .com, the entire TMT bubble burst, which caused the industry, which had made up 30% of the market, to decline by 50%, while the S&P remained unchanged. And you may have added during that range of 5 to 6 months, what's not to appreciate about selling the most shady Pet.coms while purchasing a Coca-Cola? That is precisely what took place. They add through the craziest first, followed by the junior growth stocks, the intermediate growth stocks, and finally Cisco, which was for about 8 minutes the largest company in the world by market cap, and they've all been down collectively 50%. I want to think of them as the kind of pessimistic termites. When termites spread to the broad market, the entire 70% rolled over and collapsed 50% in 2 years. And the Nasdaq was down 82%. The balance of the market was up 17% at that point, making it appear to be wonderfully robust. The underpinnings have the advantage of always looking great. The market did not peak in 1929 because investors believed the foundations to be weak. They peaked at the point in time when market enthusiasm for the underlying ideas was at its highest point ever. At the height of the housing bubble in 2007, Bernanke and the lads heard the U.S. housing market had never dropped, which they took to mean that everyone, including Federal Reserve Chairman Alan Greenspan, thought the system had never been better. It only served as evidence of a robust U.S. economy. The underlying principles were excellent, but they have never been implemented correctly. The Federal Reserve, in particular, has never had a clue about asset bubbles. Its policy doesn't even mention them, except for the rare occasions when they claim credit for the wealth effect's role in raising economic alert. They behave as if they don't exist. Greenspan, Bernanke, and Yellen all expressly claimed responsibility for advancing the economy, demonstrating that there is an income effect and that it does improve the economy alone. What they failed to do was to accept blame for the fact that the market has built-in mechanism for reverting to fair prices, and that when it did so in 2001 to 2002, it had a terrible adverse impact on income. The economy was negatively impacted in 2 ways when the housing market collapsed, which was even more severe than the impact in 2000 because it also affected the equity market. And unlike 2000, this time we're truly playing with fire because in my judgment and that of many other bubble students, the US equity market is at its most exorbitant price ever. Jim Grant would argue that this is the most overvalued bond market in 4,000 years. 3 weeks ago, the housing market hit the very same ratio of median family income that it had the height of the housing bubble in 2006, and recently, commodities have run amok. Therefore, the peak of 2011, which was considered to be one of the supercycle commodities occurrences, has just been matched by the Goldman Sachs Index of Non-Energy, which includes food and metals that are rather significant. We have never before risked having 3.5 asset classes bubble at the same time. So this is a first. The possible unraveling refers to the perceived wealth being far higher now than it has ever been if and when we enter a period of pessimism. The interest rate argument, in my opinion, explains how we behave in order to arrive at that conclusion. It is by no means a justification. By choosing the bond market, the most inflated asset in human history, you are not justifying anything. In comparison to that, we are only somewhat overvalued and hence relatively less expensive, which is a pretty chilly consolation. The Solomon Brothers, a significant company at the time, appeared before a head squad in 1989 to defend the Japanese stock market, which according to estimates at the time was trading at about 65 times earnings. The information was displayed as 65 times earnings, which had never before been sold beyond 25. And that was, to put it mildly, the real McCoy and this group moved around pointing out that 100% PE would be fair given the low raid rates in Japan.
Let me know in the comments if you have any other questions about investing. Let's return to the video.
Naturally, the subsequent crash in land, bonds, and stocks was catastrophic in 1989, and neither their stock market nor their real estate market have recovered to that point. This serves as a reminder of the cardinal rule, and that is the more expansive the bubble, the more clever the justifications, and the more expansive the bubble, the more agonizing and prolonged the decline. 3.5 of the 4 major asset classes are unmistakably in a severe bubble area, making this the broadest asset bubble in history, as I previously stated. I get the logic, but choosing one of the 4 bubbles and believing you have no choice but to do so is a rather grim way to look at life. If you choose incorrectly, the bubbles will likely all pop simultaneously, and you will experience great suffering. And as the market collapses, the conceptual meaning of that argument that they were all bubbles, thus we had to choose the least awful one, will reverberate in your mind. Everything would be in order if there were 12 to 15 years of a flat market, good earnings, and market rotation. And practically every portfolio manager I've ever encountered has thought it may happen during market bubbles. Sure enough, it happens. The market detests prolonged sideways moves because, as we all know, it either goes up or down, more than you anticipate. An extended sideways movement is always possible, but it never materializes. Just to add, I have a great deal of compassion for those who have been involved in bubbles. When I was young, in 1969, we had a fantastic mini bubble in little stocks that had doubled in value and made us wealthy. However, they all burst at once, and the majority of them went out of business. I had just graduated from business school when I gained a modest fortune that was almost sufficient for me to consider retiring to England, and after losing everything over the course of around 9 months, I managed to recover my leverage and exit the situation without incurring a significant debt. It was incredibly thrilling, maybe the most thrilling period of investing I've ever experienced. So I completely understood why no one who is young and investing and generating money would listen to an old codger. Therefore, nothing I say will influence anyone to alter their behavior. Since the tulip bubble, we have known how powerful a bubble's ability to psychologically draw everyone in is, and this trend will never end. It feels as mentally challenging as reinvesting when it's terrifying, but they both get the idea. I suppose I could ask myself, what is the least bad, while I scan the area? The least problematic is emerging markets, which, although slightly expensive, is at one of its 3 maximum points of divergence from the S&P 500. The other 2 examples both turned out incredibly well for emerging markets. On the other hand, when emerging markets was at its pinnacle in 2007, when it sold at a premium PE to the S&P, very horrible things could happen, which is exactly what happened. However, emerging markets are comparatively very inexpensive and fairly close to fair value. Another factor is value versus growth, since low-growth companies have been crushed by higher growth equities for the 10 years culminating in 2019 before having by far their worst year ever in 2020. As a result, you had the worst decade followed by the worst year. In addition, with 1974, the ratio of value, or low growth to high growth, reached its co-equal highest and widest point ever. The result for value after 1974 was wonderful, so I would examine the intersection of those two concepts. If you could purchase value equities in the emerging market universe, which you can, and which includes some nations with very strong development potential like China, they would almost likely expand faster than the developed world as a whole and trade at a significant discount. You could lock them away for 10 or 20 years and just really expect a reasonable return, which is what I would advise. And since there is no chance of convincing people to actually get through stocks, that'd be the best I could offer. I will indeed say they are modestly cheap in a S&P world that really is way overpriced. However, for the 3 individuals out there with steel wills, I would also advise having a cash reserve of 20 or 30% of your psychologically tolerable income to take advantage of far more affordable prices at some point in the not too distant future. If you had a 70-30 portfolio, 30% cash and 70% inexpensive emerging markets, I have no doubt that it would be a very resilient one. I would have as many low-growth emerging markets as I can tolerate, and a cash reserve as many as I could stand. For the next 10 or 20 years, it will be as far away from expensive assets as you can get. But I do believe that the S&P will underperform, just as it did from 2000 to 2010, when it had a negative return and emerging markets beat it by 10% a year compounded.
Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.